111 times itself. Brokerages. Morgan Stanley has an overweight call, target of 63.59. They're saying that gross margin compression implies some inventory write-off. Jefferies as a whole call, they've raised their target to 5,900 rupees. They expect 35% compounding in standalone revenue over the next 3 years. So we'll keep an eye out on trend today. Saw some short covering in yesterday's trading session. The question is, does it continue today?
All right, we're just sort of a couple of seconds away from market open and we'll have the rates come up on your screens in a bit from now. So it's absolutely flat, nothing on the Nifty. It's actually like yesterday, we started with very, very flat prices, about a quarter lower though on the Nifty now, about a quarter lower on the Nifty Bank as well. The Sensex is down about 0.25%. Small cap and mid cap indices were up about a quarter yesterday, while the other indices were flat. This morning, there is, I think, a little bit of pullback here as well, but nothing large, nothing noticeable or something you'd quibble about after the gains and the pullback that we've seen come up recently. Let's quickly look at the Nifty heat map, which should give you a quick view of the lay of the land in terms of how stocks are opening up and down, at least on the 50 stock index. So it's mostly all down, 35 odd names lower, and the rest of the 15 odd names are starting the day in the green. And I do spot one defense name, BEL, in the green, at least on the Nifty, and I think there'll be more outside of it as well. Surabhi.
I was looking at exactly that. Are the defense stocks continuing their show from yesterday? Yes, they are. Look at Para's defense. I mean, straight away 9% on Para's defense as the market's opening up. Garden Reach Shipbuilders again 3.5%. Mazgaon, the Cochin ship, the whole move has started after a 10 to 20% surge on these stocks just yesterday. So watch out for this space. Very, very hot. Anyway, back to the frontline indices. What's up is a little bit of pharma. Sun Pharma, Dr. Reddy's, Cipla, all of them on the higher side. HDFC Bank is ensuring that there is no wider fall. L&T and HDFC Bank, along with TCS, are the three big boys that are batting for the bulls. Otherwise, it's becoming a little quiet. Of course, BEL, as part of the defense pack, continues to do well. But otherwise, there's a big casualty in the Bajaj Twins. Finance and Finserv are really taking it on the chin after the numbers. 5.5% lower on Finserv, 4.5% lower on Bajaj Finance. Trent is down 3%. Now that the markets had a chance to look at the numbers in detail. IndusInd Bank itself is down 1.5%. So this is interesting. There's no panic around IndusInd Bank just yet. The market is taking this exit in its stride. SBI, which is looking at an equity fundraise soon, stock down 2%. Overall, the market is quiet. And the Nifty is nursing a cut of 50 points at the start, but mid-caps falling a little more, Nigel.
Well, that's right. A few mid-caps are actually under pressure in today's trading session. Just a quick point on the Bajaj Twins. The problem is the stocks are up 25 to 30% in the last 6 months or so. So irrespective of what the numbers would be, they have to be really, really good to see some kind of follow-through. From stocks in the broader markets that are moving around, Paras Defense, as you mentioned, Vishal Mega Mart, that's up close on 3.5%. You have the tailwind coming in for the OMCs, BPCL, IOC, HPCL. All of them are up to around 2.5% because of, crude oil prices as well were down overnight. So those are a couple of counters that we're looking at. Tata Motors is coming for profit taking. You have Samvardhana Motherson as well that's coming for profit taking. And Suzlon, that's the other name that's in there with a bit of a cut. Volume's pretty high on all of these names. A few more stocks just to note. PB Electroplus, that stock is up close to around 3.5% in a market that's a little bit wobbly. So that's one of the movers on the upside. V-Mart Retail as well is up close to around 2.5%, so good going out there. And Fed Bank Financial, that's the other stock that's actually a little bit higher. Trying to find some winners, so just thought I'll highlight a few. Jana SFB, that's down 7.5%. Praj Industries, we'll get the management soon. That's down close to around 7%. Shopper Stop, down close to around 5%. So just highlighting a few movers from the broader markets. After a while, though, the breadth of the market is firmly in favor of the number of stocks that are declining. You have close to around 1,400 stocks declining for around 400 stocks that are advancing.
All right, so that's basically the start. It's more decisively down now. If you look at the small cap index, it's down 1.25%. The mid cap index is down 0.6. So a little bit more as compared to the Nifty and the Nifty Bank, which are down about 1/3% and 0.13% respectively. So that's a start this morning that we are able to work with. And of course, most of the result reactions are all mostly on the downside. News and news-related stuff is all on the downside. There's not very little except BPCL maybe, which is showing some green, 320 on BPCL right now. Manish Sontalia is with us, Chief Investment Officer at MK Investment Managers. Manish, good morning. Good to have you here. Thanks for your time. You've been bullish. You've been saying, well, the market's The market's going to bounce. It's bounced and bounced sharply. What's your sense, Manish? Is there enough to do in terms of individual stocks from here, given earnings and growth visibility, and in which areas?
So Prashant, 22,000 has held, and I have maintained that 22,000 won't get decisively broken. That's played out. I think for the next 1-2 months, till the point in time you have clarity on the tariff, and basically that 90-day pause, out of which 15-20 days has already gone. So next 1-2 months, I think markets are going to be range bound between 22,000 and 25,000. Can't really be seeing an outbreak beyond 25,000 given the macros that we are in, given that earnings season is somewhat okay, not very great. So I would believe that we'll consolidate, and right now it is more about institutional buying. The banking space, the heavyweights, Reliance. You have the technology space after the correction. So I think it's more to do with smart money buying in and around the indices, the heavyweight indices level, rather than individual stocks at this given point in time. So it's more to do with index management. Currently, now that we have bounced back 10% from the lows, I would believe that you'll see broadly the heavyweights on the index largely play out on the positive side till about that 25,000, and then we'll be basically consolidating around that point.
Manish, hi, morning. Great to have you on. I know you won't talk stocks, but maybe we can get a indicative direction. I'm looking at Bajaj Finance this morning. It's down 4.5%, almost 5% actually. And the only, I think, crease in the earnings, if one can find, is maybe the fact that they have taken certain ECL provisions. And I think, that's the talk point, whether credit cost indeed is peaking out now or not. 1.85 is what they're guiding for. But in general, the stock has done so well, right? Look at the way NBFCs have rallied in the last 2 odd months. What would you do with the NBFC space? Would you go here? Would you stick to banks? And how does one look at, and Shriram Finance was the other casualty in this earnings season. So it's been a little odd for these large non-bank lenders. Your thoughts?
So first of all, numbers were pretty okay for Bajaj Finance. I would believe it's to do with, the maverick, Mr. Rajiv Jain, who is now becoming the vice chairman. He has led the company from the front over the last 20 years. And now, he is going to be the vice chairman. So I think market is somewhat, not used to not hearing Rajiv Jain on conference calls henceforth. So that's one point. Secondly, credit costs are definitely, something to worry about as far as the Bajaj Finance numbers are concerned. Nothing alarming because they are still guiding for AUM growth of 24-25%. It's to do with valuation. The stock has run up so much. But I think, it's nothing fundamentally wrong with the company. They are guiding pretty good growth. The valuations are pretty full at these prices. So maybe that's the best time to take profits. I could read just that into, Bajaj Finance. The NBFCs as a whole, whether you look at Chola or Shriram, there's some concerns around the NPA numbers. Even Chola numbers, NPAs were slightly elevated. Bajaj was already a disappointment as far as the ECL provisions are concerned. Of course, they called it out as one-off, but markets have their own reading of the same. And similarly with Shriram Finance. So, the sector remains in a sweet spot because repricing of deposits are happening immediately for NBFCs in line with lending rates. So they are able to maintain their spreads much better than banks because liabilities on banks will come down over a period of time, whereas lendings reset on MCLR, EBLR is happening immediately. So
So buy or not buy? Sorry, coming in over here to try and squeeze in more in the time. Point is, when you see these sharp dips, whether it's Chola, more importantly Bajaj or a Shriram, is it all passing, manageable? So buy the dip or stay away?
Let's buy the dip. There's no doubt about it. There's nothing alarming about these banks or NBFCs, just that out of profit taking after they have rallied 20-30%. That's about it.
Okay. Hi, Manish. Good morning and good to see you, Ben. If I remember correctly, you were quite positive on capital market related plays as well. And from that space, a couple of stocks have done very, very well. But now valuations, they could be a bit of a headwind. Currently, what are you bullish on from here on? Because a BSE, well, it saw a sharp correction of 30%. Guess what? it made a fresh all-time high yesterday. So what are you bullish on this theme now?
So, it's got to do, I mean, I can't understand the valuation difference between unlisted NSE and the listed BSE. BSE is trading at 90 PE plus, and, unless and until earnings surprise massively on the positive side, for BSE, even that's not, quite doable currently, given the regulation change around settlement dates. So, difference in NSE and BSE valuations, 30 P out there, out here you have 90 P. I mean, there you have 90% market share, you have broadly 10% market share. I think on the BSE side, it's more to do with bonus stripping, all of that just comes about. But capital market plays, etc., looks quite decent in this downfall. I'm particularly more bullish on the depositories, RTAs, asset management companies, whatever asset management companies have reported numbers. They have all gone up from their lows. And I think from a medium-term perspective, they all look quite good. Even the broking platforms, selectively, wealth management platforms, I think they are all investable from a medium-term point of view. You're getting it at lower prices, but just keep in mind the valuations, exorbitant valuations, 50, 60p won't hold. But anything like 25, 30, 35p, these platform companies are likely to create wealth in the medium.
Okay, all right. I think if I remember correctly, you're also positive on health insurance.
Yeah.
That theme has not yet played out, I think so. Tell us more.
So Star Health reported numbers yesterday. Underwriting profits were disappointing. Investment gains were pretty okay. I think it's a work in progress. The fact is that you are getting at 15, 17 PE multiples, and increase in premium rates around the corner. So claims ratio for some of these leading health insurance plays are best in the industry. 65 to 69 odd percent. And plus, you're looking at increase in premium rates. That would mean that you are looking at implied growth rates of around 25 to 30%, and you're getting it on multiples of 15 to 18 times, which is basically less than 1 PEG. I think a good investable idea, without too much of risk.
Sure. All right, interesting call out there, because the IPO was at around 900 rupees. The stock has come down to under 400 rupees. But you believe post the correction and given the tailwind that it has, you believe valuations now are more palatable. So that's in Star Health.
Okay, got it, Manish. We're really, relishing it this morning. You're giving such wonderful perspective on these, big movers, which are of all, earnings driven. So I'm going to take my chance with one last one with you. Trent, just your take on the business. Dream run, or is it over? Is it really over? Because you cannot sustain at maybe 70, 80, 100% growth rates. And the stock is still at what, 70 times forward earnings. What should current investors do? I mean, same question, buy the dip or just stay away?
Trailing 12 months is 100p. So I think it's it's got to do with valuations. There's nothing wrong with Trent, great company. But 15% margins, this time around they have reported 16% margins. Whether that's going to sustain, that's the big call. But execution holds and valuation holds. If the valuations come down to less than 3 times price earnings growth, it could be an investable idea. But currently, valuations are concerned.
Which would be where 3 times PEG for Trent would translate into what sort of CMP, roughly?
100p, so it's grown at 35% on the top line. So multiplied by 3 times, you get 100p multiple.
Okay.
Right. Zomato, Manish, any thoughts? Zomato, Swiggy?
I think, whatever narrative is coming around in social media regarding, problems at Zomato, still, I think they would be the last man standing, given everything. A lot of positives as far as operational leverage is going to play out for them. And yes, opening of dark stores and discounting by competition would take some sheen off the Blinkit SOTPs. But even then, there is some margin of safety from where we are in Zomato. So I'm not negative on Zomato at all. In fact, it's one of our portfolio holding stocks. And the simple understanding is that, this is basically irreversible. The quick commerce and food ordering that has become a habit. India wants everything in 10 minutes. That's become a habit. It's not reversible. That's one. Secondly, if there's anybody who's going to have the economies of scale and would be the last man standing, it's going to be Zomato. Yes, Amazon has deep pockets. You have a Flipkart which has deep pockets. But to get the unit economics right, you'll have to burn a lot of cash. And I mean, it's an evolving situation, but currently it looks like that, Zomato is in the best form and shape as far as the growth and the valuations are concerned.
All right. Thank you very much. And just platform companies, right? I mean, you start with capital market plays, and I mean, these are, of course, in the different space, but all kind of tying in with broadly consumption and consumption growth. Thank you very much, Manish, for joining us. A good conversation as always. Let's get on to the earnings treadmill, and I think CEAT is the first one.
Well, that's right. Let's focus on CEAT. That's the management on our radar. Earnings were better than estimate. The revenue growth has been good, driven by domestic demand, both in OEM as well as in replacement market. But margins, they've slipped a little bit on higher input costs. To discuss this and more, we're joined by Mr. Arnab Banerjee, the Managing Director and CEO at CEAT. Hi, Mr. Banerjee. Good morning and good to see you in as always. Congratulations on a good showing actually in the past year. Double-digit revenue growth, double-digit growth even for Q4. Give us the outlook, though, from here on. For FY26, can you continue to grow in double-digit on the revenue parameter? And since you get more than 50% of your money coming in from the replacement market, what's the signs in terms of the economy? How are things on ground? Please go ahead, sir. Mr. Banerjee, I think you'll have to unmute yourself, sir.
Going forward, we would definitely like to carry this momentum of double-digit growth overall right through the year. The trends that I talked about last time when I was around continue. In domestic aftermarket, the urban market is urban areas, which is greater than 50,000 population towns, is a little soft on demand. Rural areas are doing much better. There is a clear delta of 4 to 5% incremental growth in rural for us, and we have the distribution reach to tap into that, so that's positive. OEMs, we expect the approvals to keep coming in for larger rim size tires and passenger, which I have been talking about, which we are focusing on. And we would like to see our share going up in that area, as well as in truck bus radial and two-wheeler. So OEM, we are bullish vis-a-vis visibility that we have on approvals and the sale of those vehicles going up in this FY26. Globally, it is uncertain, as you all know, because of the tariffs and even other ongoing things, the war and some of the tariff and non-tariff barriers. So it will continue to be uncertain. So in balance, I would see most of the trends of FY25 continuing in FY26.
All right, so double-digit growth is what you're gunning for. Could you tell us, what about the inorganic growth? You had made that Camso acquisition, and as you said, I think it would add roughly around, ballpark, I think 2,000 crores on your base of close to around 12,000 crores approximately. Does it start contributing in this year? And what are you penciling in out of that? And this double-digit doesn't include Camso, or does it include it?
This is standalone.
Standalone.
Yeah. So Camso would be integrated into our business in Q2. All the antitrust issues are now done away with. All regulatory decks are clear. We are in accelerated mode of integrating the business. Q1 will not have any consolidation from Camso side. Q2 onwards, we will be starting to consolidate the Camso results into our system line item wise. It's too early to say how that will pan out, because there is some turbulence always when a new set of owners come in. But we would like to focus on business continuity, retention of talent, retention of customers in the first 2-3 quarters, and then we'll take it up from there.
All right. Mr. Banerjee, good morning. How's demand for the recently launched 3 tires targeting the premium segment? And what's the market share in that segment currently?
The 3 tires that we launched are Run Flat tire, which is the first time an Indian manufacturer, Indian brand is bringing to India. 21-inch rated tires, and Calm tires, which is very relevant for the electric vehicle trend. These are niche products right at the top end for top end cars. Volumes are very small at this moment, but we expect to take a pole position there. This is going to grow in future, and this is especially 17-inch plus volumes in passenger car tires is just going to skyrocket as a proportion of the entire aftermarket. So volumes are still small, so market share doesn't make any sense to talk about right now, but we expect to have a leadership position going forward.
Mr. Banerjee, in the third quarter, I think at the end of that quarter, in the analyst call, you had pointed out that your overseas business was growing really well. You were seeing good demand from Europe. Now, with this whole trade disruption, what is the expectation? If you could just give us the split between the international business and the domestic business, and then also the split between the growth trends, volumes that you're expecting on both fronts.
So about 19 to 20% is coming from international business. This doesn't include Camso. This is CEAT standalone. And that ratio is being maintained right now. You're right. We have done very well in the EU area. And we continue to do well. And that's the most stable part of the business. Good on margins, good on growth. In all categories, in farm, OHT, passenger, as well as truck bus radial. The US business is small, but that's a future growth area. So the risk there is to future growth. But as of now, the exposure to US and therefore the impact of what's going on directly because of the tariffs proposed by US is not going to be material in FY26. There are headwinds in other parts of the world also, for example, Latin America. The areas which are doing well, apart from Europe, are Middle East and Southeast Asia.
Mm-hmm. Just to follow up on this, are you hearing any of your European clients, the big OEMs, talk about delays or deferring, any of their plans? Because, for instance, I mean, look at Tata Motors. They announced a halt on all JLR shipments when this tariff news broke. So, are you expecting any sort of a slowdown in the European business? And also US, since you mentioned it's still an opportunity, just tell us what sense you make of the tariffs. The news changes every day. Now we understand that they're quite open to components still coming in. So would you look at expanding your presence in the US at all?
No, US is definitely a future growth market. As I mentioned, we are already present with our OHT business, which has started taking shape. We have just launched our truck bus radial and going to launch our passenger car radial this year. We are setting up our network. So nothing is stopped. We'll have to see the business model and the profitability and the product range that may get altered. We are hopeful of suitable, free trade agreement between the two countries coming along by the fall season. But if things stay where they are, India as a country doesn't have a competitive disadvantage vis-a-vis the US market, vis-a-vis other country as competition, which is, let's say, China, Thailand, Vietnam, etc. But things are fluid. It will evolve. We'll wait and watch. And as I mentioned, no material impact in FY26, but it's our growth market and we are keen on investing in US.
Okay, all right. Mr. Banerjee, the raw material costs have cooled off. And that's what's helping your gross margins improve. I think the last time around as well, we briefly spoke. Your target, I think, is to get the gross margin back above 40%. And that could happen in the coming quarters. Given that, what kind of a EBITDA margin should we be working with for the coming quarter? Will quarter one be better than quarter four? And from then on, do we see some kind of stability? A margin band, if I could request you for one?
Yeah. So let me first talk about the raw material situation. Quarter four on quarter three, the crude prices actually didn't change much. Quarter one is definitely cooling off. So crude derivatives will gradually come off their current price levels going forward. Natural rubber international prices have come down to about $1,700 per ton, but domestic price is still holding steady at around just lower than 200 rupees mark. So that has not come off. Rupee has just now started appreciating, but it was depreciating earlier. So there are various factors at which we are looking at. The entire basket, if you see, quarter four and quarter three, it was almost flat, minor drop. Quarter one on quarter four, we'll see a very little drop, almost flat. Quarter two onwards is when we see raw material prices probably cooling off significantly. And that is when margin expansions may happen. And you're right, we are comfortable operating at 40+% margin. So it'll take a while to get there.
EBITDA margins should hold in that vicinity of around, say, if you want to give us a range for the year, given that the benefits will flow in from the second quarter, should we be working with a rough number of, say, around 12 to around 13%?
We would like to go there, but it's too early to sense of what it will be at this point.
Got it. Just a quick question as well with regard to your capacity. Last year, I think you spent close to around 1,000 crores on capex. This year, what is that number that you've laid out in terms of a capex? What is your current capacity? Where is it headed? And what does it mean in terms of your debt?
Right. So on a standalone basis, again, I'm taking the Camso thing out. We will continue to spend around 1,000 crores, maybe 900 to 1,000 crores or thereabouts in terms of capex. About two-thirds, about three-fourths of that will be growth capex, and all will be continuing on the same brownfield expansions at Chennai, both passenger and truck bus radial, at Ambernath for OHT, and maybe a little bit in Nagpur as well for two-wheelers. So mostly brownfield expansions is going to continue. And capacity utilizations are around 75, 80. In some cases, it is close to 85, 90% passenger car tires, which is why we will expand at Chennai.
And debt number, sir? What is it? Where is it headed?
Debt numbers have gone up by about 100 odd crores, little less than 100 crore vis-a-vis Q3, as you have seen at the end of Q4. So as far as standalone business is concerned, it will be around similar range because we expect cash accruals as well. And with the capex at 1,000 crores, not much imbalance is expected in the overall debt. Minor change may be there.
Mr. Banerjee, you used the word this was in relation to the answer on premium tires, the newly launched top-end segment. You used the word skyrocket for one category. What was that? Which one was that?
All the premium, the entire premium segment, which is large rim size tires, is going to, right now it is just about 10% of the market. In terms of salience, this is going to really, really grow very fast in the next 3 to 4 years.
You know, Mr. Banerjee, allow me to ask a tongue-in-cheek question. This is coming in from a viewer, a very troubled viewer who's got to drive on Mumbai roads. He's asking me to ask you whether there is any bump in demand, especially for what you sell in Bombay, in terms of replacement demand or otherwise, because of the condition of roads.
Yeah, can I add a question to that, Prashant sir? Also, can you invent a tire that remains absolutely puncture free, resistant to Mumbai roads? On a lighter note, we're just joking here.
No. So run flat is very close to that. Tires are supposed to take care of any such issues, and you can travel up to 80 kilometers till you tend to the tire. So there is a very big consumer proposition, especially for the higher end cars. So yeah, it sort of addresses that problem, Mumbai or otherwise.
You've tested those on Mumbai roads, Mr. Banerjee?
We tested them on much worse roads.
All right. Well, we'll leave it there. Thank you very much for coming on and being a sport about it. And, of course, answering all those questions with regards to demand, etc., and the outlook at CEAT.
Prashant, over the weekend, sometimes we used to go on these bike rides, a group of bikers, because we wanted to test
off-roading.
Off-roads.
Now off-roading is in front of your house.
You don't have to go anywhere.
It's all off-roading throughout the city.
You should go 300-400, very, very far, 3-4 hours away, just to go for off-roading. But now it's just done.
No, actually, if you think about it, somebody should make an estimate. Actually, the actual cost, right, to cost of maintenance of cars, man hours, forget about it.
Yeah.
Even, the number of backs which
wear and tear.
in bodies. It's just a terrible sort of situation if you've got to drive and be on roads for a long time here in Mumbai, as many have to be. We'll take a quick commercial break here. We're going to come back. We'll connect with the management at Praj Industries to discuss the company's fourth quarter earnings. Stay tuned, coming up.
Welcome back. We're still analyzing lots and lots of numbers and earnings that have come in over the last 24 hours. Praj Industries is the next company on our radar. And before we get started, let's just go over the numbers very quickly. It's been a tough quarter for Praj once again. Q4, the revenue is down 16%. The EBITDA has declined by about 43%. And the margin has come down from 12.8% a year ago to just about 8.6%. So it's been tough going, and not just that, it's been a fairly tough year as well. Full year numbers, if you look at FY25, it's not a one-quarter situation. Revenue down 7% for the year. EBITDA has declined, quite a bit, and the profit is also down 23% for the year. So what is plaguing the performance? Let's find out. Sachin Raole, Chief Financial Officer and Director Resources at Praj Industries, is with us. Sachin, good to have you on. And that's really the question. I mean, we want a slightly bigger picture perspective here, because this is not a Q4 phenomena. It's been a tough year, degrowth this year, and I think there was some degrowth last year as well. This is despite the fact that you keep announcing a lot of new big wins, like the one with BPCL, like the one with your overseas clients. So why are these big contracts not translating into the P&L performance that shareholders would like?
Hi, good morning. Let me just tell you this story, what is happening or unfolding at our end over a period of last 1.5 years, when we actually started talking about how we are looking at a longish picture of 2030 and how we are growing other vectors of the company beyond the ethanol. So over a period of last 1 year or 1.5 years, to be precise, we are actually in a very big transition phase, which we are right now witnessing. And this transition phase is on multiple counts. One, how the business vectors are supposedly to keep on growing. And you must have seen a large amount of investment which we have made in the new facility built up over a period of last 1 year. That facility is now operational, has started working on the ground. The investment is very, very huge. It's more than 100 crores as per the standard of Praj. The last year we have seen the investment happening through profit and loss account, because the facility is operational. It was made operational for getting the facility audited and approved by the international customers, which has just happened. And now the order booking will start happening in that facility. So the last year has actually witnessed a big investment going in that facility. And that investment is actually rooted through P&L and profit.
If you could just allow me to understand, you're talking about Praj GenX, right? That is right. Where all the investments have happened and you finally commissioned, and now you're expecting that to flow through. So some numbers, year one in terms of revenue, when does this facility break even? And again, I'm going back to the big number, top line growth for the company, EBITDA growth for the company as a whole. Will we see that in FY26?
Yeah. So 26, we will be actually seeing the order booking happening for Praj GenX. The numbers which we are looking at are going to be very different than what we had done in Praj Industries itself. So those numbers are going to be definitely on a very large scale, because that capacity is almost 4 times of our existing capacity. This was built up to take up large modularized projects, especially on the export side. So the numbers are going to be different for order booking and also for revenue. So we are expecting next year, FY26, we should actually be breaking even on the GenX side.
27, not 26. This is 26, sir. So you're saying Praj GenX will break even in 27. Give us some sense of the revenue scale up. Some idea in FY27, how much does it start contributing to the revenue, and when do we see the top line growing again?
So in FY25, the year which has just gone by, the revenue on the top line is around 28 crores for GenX, but the bottom line is almost down by 80 crores. Because there were no enough operations to compensate for the cost which we are incurring for building up this facility. So there is a 80 crore kind of a pressure on my bottom line in the current year, and this is what is getting reflected in my consolidated numbers.
All right. Hi, Sachin. Good morning. Good to see you in. This is Nigel on this side. Now, for your shareholders, they appreciate you giving us some color on segments of the business.
Sure.
But for the company on the whole, what kind of a revenue growth number can we work with for FY26? Give us a broad range as well. That is doable. And margins have been steadily, coming down. Used to do early teens margins. That's come down to around 9%. What should be the range on an average for the year? 2 numbers, revenue growth and margins. Please go ahead, sir.
Sure. So if you look at my current year's turnover is around 3,200 crores on the top line.
Yes.
And the carry forward order book, which we are carrying on our books right now, is 4,200 crores.
Correct.
It can give some kind of an idea what kind of a revenue growth we are expecting in the next year.
So
based
you'll
on
execute the full order book, sir? This 4,200 crores, most of it will get executed in the next 1 year?
I think at least 75% of this definitely should get executed in this year, because some of the orders are long-term orders, and there will be some order booking which will be happening in the first half. So generally, if I look at our trend, some portion of our first half of the year also gets executed during the year. So it is not only the backlog which contributes to my revenue. So it is a combination of both. So it can give you some kind of a sense.
So 75%, sir, we have done the maths, sir. 75% of 4,200 crores is approximately 3,200 crores.
That's
Plus,
right.
there will be some more revenue recognition. So on the base that you delivered last year, at least a high single digit to double digit revenue growth is something that we could work with?
That's right.
So should we take it at approximately 10%, sir? That could be...
Yeah, you can consider that kind of a growth rate at least for the next year.
Got that. What about margin, sir? You were making that point. Please go ahead. What is the number we should work with?
So margin, according to me, on the EBITDA side should be somewhere in the range of double digit. For a reason, because the orders which we are going to execute in the next year are going to be majorly on the international side as compared to the domestic side. So that will be EBITDA accretive for the next year.
Got it. Okay. All right. And the 10,000 crores of, the target that you have by 2030, that is still on, right?
Absolutely on. Absolutely on.
Sir, just a question on the specifics now, the alliances that you've announced, the one with Sensex on PLA, polylactic acid. Just tell us a little more about the contours of this deal. What is the revenue share? When does the money come in? I mean, when do the revenues accrue?
Okay, so last year we have put up our demo facility for polylactic acid. We have gone into this kind of a partnership with ThyssenKrupp for the polymerization of polylactic acid, which we are going to produce. So the idea is to provide a solution, end-to-end solution, starting from a feedstock to polylactic acid under one umbrella. And the Praj is what is going to execute the entire project for our customers. This is just the beginning. It is now ready for commercialization. We are speaking to our customers for putting up this kind of a facility. There will be some development in FY26 on this front. What will be the revenue and what will be the number? Unfortunately, I will not be able to divulge right now. But yes, there is a big activity which is going on in development and a commercialization of PLA at this point of time.
Right. Sachin, good morning. This is for the biopolymer production, is it?
That's right. It's a biopolymer production.
Okay. This is the same thing which Balrampur is now getting into, right? They have a plant which is coming up for commissioning as well.
Right. That's right.
It's a up and coming sort of sector. Lots of demand, of course, long runway for growth.
Yeah.
This has all been cleared, right? I mean, in terms of the end markets. I mean, regulatory approvals, etc. The products, yeah.
So this is basically replacing a normal plastic.
Correct.
We are getting into bioplastic, so you are replacing the fossil-based plastic. So this is an upcoming market, definitely from a sustainability point of view. There is a lot of interest because there are very, very minuscule number of players who are in this field. And Praj is right now completely ready in providing the entire technology, end-to-end technology, with the help of ThyssenKrupp. So you
will set up this plant, is it?
No, we will be providing the technology and we'll be putting up a project or the plant for our clients.
I see. So, for example, if Balrampur wants to do it, you would go in as a supplier. Got it.
Just a quick ratio here, since you're talking about the company going through a transition and you want to move away from ethanol. Give us the roadmap, sir, in FY27, when your GenX facility comes on screen. By FY27, how much revenue is going to be ethanol and how much non-ethanol?
Okay, so our stated target for 2030 is that 50% business will be bioenergy and 50% business will be non-bioenergy or the engineering business. Within this 50% business of a bioenergy, we are not saying that we are going away from ethanol. We are saying that we will be adding more layers of other bioenergy segment also apart from ethanol. Within ethanol, we are seeing that we will not remain only because the domestic wave for last 2-3 years was very, very high. We are seeing that we will create an equal wave for ethanol business in the international market also. So ethanol is not going away. Ethanol is going to be there. There will be some different applications because we have gone for some valorization, some product development within the ethanol, which are ready for the commercialization in FY26 itself. So by FY27, according to me, ethanol or the bioenergy segment will be still on a higher side, but a major portion will start coming up from the engineering business also. And the trend we have already started seeing in this year. And that will get accelerated over a period of 27-28. And by 30, we will be having 50% bioenergy and 50% non-bioenergy.
Okay, all right. Sachin, you've given us quite a few numbers and we get a sense about how business is progressing. Request you for one more. Your order inflow has been roughly around 1,000 crores on a quarterly basis. What kind of a number are you working with on a quarterly basis, or you want to give us for the entire financial year FY26?
Oh, generally we
don't disappoint us. Don't disappoint us, Sachin. You have given us so much. Just one more number.
No, I can imagine that you are looking for some kind of a number from me. Unfortunately, we don't give that kind of a guidance. But let me tell you, on all the business verticals, the inquiry basket is very, very strong for us. And naturally, we are looking for a growth. We are not looking for a growth on the order booking next year.
Got that. We'll leave it there. Good conversation, lots of details, and look forward to the next one. And good luck as you continue to execute. That's Praj Industries with some amount of guidance and some forward-looking statements for their business coming through. Well, let's talk about global shipping. Amidst the US-China trade tensions, and of course, global trade tensions, shipping as a sector is in focus. We have Mr. G. Shivkumar, Executive Director and Chief Financial Officer at G Shipping, who's with us. Mr. Shivkumar, good morning. Thank you for joining us. So let me just get this data to you, right? This is data on global TEU containers. I know you're not into containers, but just to give you a sense of the, what's happening globally. This is as of the 14th of April, week ended 14th of April. US, this is, week on week. US imports are down 12%. China to US movement is down 22%. On a year-on-year basis, the numbers China to US is down 45%. So this obviously is a sharp slowdown that we are seeing as far as global trade is concerned. As I began by saying, containers specifically don't affect you, but the indirect second order, third order effect on tanker market, oil prices have fallen sharply. Tell us what you're seeing.
Morning, Prashant. Thanks for having me. Yes, we're not in the container business, but I think it's fairly logical, the outcome that we're seeing, which is that container trade has sort of, especially the China to US trade, has fallen off a cliff. Yes, that doesn't bode well for the container business if things continue the way they are, which is with very high tariffs on Chinese goods. But coming to, as you put it, the second and third order effects on the rest of world trade. One is, of course, if you have more inflation picking up or in the US, which leads to potentially a recession in the US, or at least slower growth, and which again leads to poorer growth worldwide. You would have a slower commodity demand as well, which would affect us. Coming specifically to US and China, there are only two commodities or two sets of commodities really which affect the commodity business in any significant way. One is propane. About 14% of global LPG trade goes US to China. And this is a trade route which has developed in the last year or so, in the last decade or so, as US shale output went up a lot. And the other is ethane, which again is a new developing trade. We are not in that at all. And dry bulk, which is grain from US to China, is a small part of global dry bulk trade, probably 1% or so of global dry bulk trade, so not as much of an impact. But yes, the signs for the global economy are not great if we have this kind of uncertainty going.
I think last night, I think propane or ethane, China has kind of cut tariffs, right? I mean, they've allowed tariff-free imports to come in.
That's right, ethane.
Ethane, yeah. But you're not in that segment, right? Could you give us a sense? I mean, is there any way to estimate, what are rates like, tanker rates like right now?
So no impact at all on tanker freight rates so far. No impact on either crude tankers, product tankers, or bulk carriers. We had a sharp drop in LPG rates. Again, this is that propane trade going from US to China. So that's a VLGC trade, that's very large gas carriers. Those spot rates dropped off very dramatically in just the week or 10 days following the Liberation Day announcements. They've bounced a bit now because, again, if the product is being, if the commodity is being produced, it will tend to get transported somewhere and you will find the clearing price for it to go to find a buyer. So that trade has bounced after that. Is bounced substantially from the lows that we saw immediately after Liberation Day.
This in the past we've spoken to you of the other thing which is going on is Russia-Ukraine, and you've maintained that shipping rates will fall sharply as and when that kind of some sort of a ceasefire is reached, and Russia-Ukraine is much more material for crude product, etc. Again, there's been some talk for a while, but some talk that something may come in terms of a ceasefire. You want to provide us with an updated assessment?
Yeah, that's geopolitics and we're not really experts there. But yes, if there is a rapprochement between Russia and the US and NATO on Ukraine, we think that it'll bring tanker rates down because that was a significant ton-mile impact. However, I don't think it's going to normalize so quickly, even if there is peace there and there is some kind of ceasefire or a peace agreement which is brokered. So it'll take time to feed through, but yes, you could have rates coming off if that full impact reverses.
Sorry, just one more broader question with regards to India specifically, Mr. Shivkumar. I mean, this, and we will hopefully over a period of time benefit with more trade as there is a shift away from China. I mean, does your business get impacted at all in any way?
No, not really. The one thing that I should mention on Russia, because we mentioned Russia, that the US is tightening sanctions on a lot of ships, whether involved in the Russian trade or the Iranian trade, both of which are sanctioned, subject to sanctions. And that's affecting the supply of ships. Now, these are tankers that are doing the trade. And so those ships are getting taken out of the system and therefore making the system less efficient. So it's not just on the supply side or where you need ships, which is from the ton-mile impact of the Russia-Ukraine war. The US is also putting pressure on the ships which are doing that trade, so you could have those ships getting taken out of the market as well.
Mr. Shivkumar, sorry, please.
Sorry, we've also seen Indian imports went down a bit from Russia immediately following those sanctions which happened in January 2025. But now they've bounced again because we are down below the EU price cap of $60 per barrel for crude oil.
Interesting. We are hearing a lot about, a lot of focus in the US, for example, with regards to shipbuilding, focus on shipbuilding, right? I was looking at data last 5 years. Actually, US has hardly made any ships. I mean, of course, it's a cost thing. Japan, Korea, South Korea, and China. Of course, China is the biggest. As an operator, because this is a long drawn story, but are you expecting a lot more supply? What's your sense?
Shipbuilding capacity in the US is very low. And as you mentioned, they are very expensive. So they don't compare in price with the ships produced from the three main producers of ships now. which is Japan, Korea, and China. So it's tough for them to compete, and it's not a huge amount of supply really. India itself is looking to boost shipbuilding, and we are probably closer on the cost curve to the big three than the US is. We are much closer if we can get those capabilities done.
And no decision on buying. I mean, are you closer to buying anything, doing anything?
No, not really. Prices are down a little bit, but not really. We are still waiting to get those attractive prices.
Okay. How as you look at FY26, how does it look compared to the last year?
So I'm not going to give
Earnings wise, yes.
Yeah, so markets are a little lower now than they were a year ago for tankers. So that's all I'll say. We have a board meeting coming up in about a week's time.
Sure.
And we'll discuss those after that. But again, uncertainty, there is so much uncertainty around everything. As we started with what's going to happen to the world economy, that it's getting even tougher to forecast these days.
I understand, and we'll speak once you sort of come out with those numbers, Mr. Jagmohan. We'll talk numbers then. Thank you very much, but interesting perspective on the space. That's the GE Shipping Management there. Well, 20 points higher on the Nifty, which means that it's a bit of a turn that we've seen coming through on the index. Absolutely, from the opening lows, we've come up pretty smartly. Mitesh is with us with what he'd want you to do. Mitesh, good morning. What's on your radar?
Yeah. So, Prashant, I think on the index, we continue with that kind of subdued kind of view, when the markets will still consolidate and you will see supply emerge at 24, 450, 500 zones. But on the stock side, you will have some opportunities. And I have a sell on Adani Green. Actually, it's just about to break below the support pivot of 905. It made a low of 911. So, sell below 905, take a stop at 925. And look for a target of around 870 to about 860 on the downside. And on the buying side is APL Apollo Pipes, I think. That's a buy with a stop below levels of 1605 for targets of 1690.
Okay, all right. Fair enough. Mitesh, we'll leave it there. Thanks very much. We'll take a quick commercial break here. We're going to come back with what's happening as far as commodities are concerned. Manisha on the other side.
Welcome back. It is Akshay Tritiya. So what else? But we have our commodity queen coming in the house now to talk gold. And Manisha, I have to start with this. Sona, kitna sona hai? What a run! I mean, on the metal this Akshay Tritiya.
Oh, well, absolutely sona hai. And the kind of gains that you've seen in the last 1 year absolutely have been glittering. You know, Surbhi, it is said that whatever you buy this day does not give you losses going forward. So it can be a business, it can be gold, silver, diamond, jewelry, but these are the things that are mostly bought. These are the numbers that I have gathered from the industry, where we understand that usually on an Akshay Tritiya day, you see a buying of between 18 to 20 tons of gold. This time around, because the prices are at all-time highs, near a lakh rupees a 10 grams, so the industry anticipates that 12 to 15 tons of buying, even then, even at these prices, is what you can anticipate in the day-to-day. We do understand that the Akshay Tritiya started last evening and it continues until tomorrow morning. So there are various auspicious hours in there where you will see people buying gold. This is a chart that tells you on how the gold prices have behaved during Akshay Tritiya in last 5 or 6 years. I mean, as you can see, from 47,000 in 2021 or even 50 in 2022, we have seen the gold prices surge quite higher. Last year, same time, the gold prices were trading at around 72,000. They're trading at 96 to 97,000 at this point in time. So nearly 23, 24,000 of a jump up in last 1 year itself. And people do buy silver as well on Akshay Tritiya. And because the gold prices are so expensive, you could be looking at silver buying picking up as well. And here as well, as you can see, silver mostly has trended between that 70s and 60s for the last 3 or 4 years, making higher highs. And this year, on 13th of March, we saw silver prices gain beyond above a lakh rupees a kg as well. So very strong gains, as you can see, in over Akshay Tritiya's for gold and silver prices there. There are various ways to buy gold as well. For the longest time, it was physical. Even now, 60 to 65% of buying in gold happens in the physical markets, which is by jewelry, bars and coins, etc. But the gold ETFs have picked up quite strongly in the last couple of years, especially in last 6 months. We have seen lesser redemptions and more net inflows. Gold mutual funds and digital gold also seems to be picking up, where you can buy gold for as less as 10 rupees and start building it up from there. So various ways of buying gold at this point in time. I also want to take you on what we've done in sense of gold prices and price rise. So for 2025 till time, we're up by 27%. Last year was 28% of gains, and in 2023, 15% of a jump is what gold prices gave you. Interestingly, it has to do with the central bank buying, which has been very, very supportive. If you look at global central bank buying, 1,082 tons was an all-time high buying. But in the last 2-3 years as well, as you can see, it has been above 1,000 tons as well. For 2025 till Feb, it has been 44 tons. But we do understand that 800 to 1,000 tons of central bank gold buying is what the street is anticipating for this year as well. So while there is support from central bank buying, investment buying, global trade tensions, markets do believe that while there could be a correction coming in for gold, but by the end of this year, you could be looking at gold prices yet again at all-time highs. The Indian markets, in the meanwhile, have seen a lakh rupees for the gold prices and a lakh 3,000 for silver prices. This is without the GST. So we've seen much higher prices when you add GST and making charges to this as well. Let's talk about the final plate now, and this is about the gold price outlook. Well, most people believe that you wouldn't see the 40% kind of gains that we've seen in the last year in the next 1 year as well. But having said that, it will keep up with the inflation. And if there are trade tensions continuing and inflation is high and you see more interest rate cuts coming in, then you could be looking at higher gold prices. Bank of America is still talking about an average of 33.50 in this year. Deutsche Bank talks about 3,700 by the end of this year, and ANZ talks about 3,600 as well. JP Morgan says that prices can surpass $4,000 an ounce as well on the higher side, so holdings are on the stronger side. BGS also talks about 4,000. John Paulson talks about 4,000 by the year 2027 or 28. So next 3 to 4 years, until the time the US president is Donald Trump, the markets believe that the gold prices will have a strong run.
That's a rather astounding correlation between the US leadership and the price of gold. Very interesting one. And Manisha also said, Prashant, that whatever you buy on Akshay Tritiya, typically you never make a loss. What are you buying today?
Manisha will fund me.
Oh, really? I'll get it for you.
Thank you, Manisha, for that. And of course, we'll continue to shine the spotlight on gold. Not that it needs a spotlight, but it's shining all the way. We'll take a quick commercial break here. We'll come back with our special segment. It's the Economy Lata in Conversation with the analyst of JP Morgan and how tariff wars will impact growth, currencies and commodities.
Welcome back to It's the Economy. Tariffs seem to have begun to hurt the US economy. I'm referring to the latest data. In the overnight JOLTS data, job openings for March missed estimates. Consumer confidence for April has dropped to the lowest level since the pandemic. But GDP numbers will be due. A lot of numbers are due today. How will growth be impacted in the US itself and globally, in Asia in particular? Today on It's the Economy, I have with me a veteran from JP Morgan, Louis Oganis, head of global macro research. He manages teams of researchers covering currency, rates, commodities and emerging markets. Thank you very much, Louis, for joining us. Well, as of now, including the 10% across the board tariffs and the 25% auto and steel, the US tariffs are averaging 25%. Versus only 2.5% before April 2nd. What will this do to US growth itself, and will it mean stagflation?
I think that, beyond the level at this stage, honestly, is not known. We have a situation where a big chunk of the tariffs have been reduced to 10% for 90 days. That 90 days are going to be completed sometime in early July. And it's an open question what comes afterwards. There is obviously some discussions with individual countries. India is actually included in there about reaching some kind of trade agreement that would potentially reduce on a permanent basis some of these tariffs. But we don't know. So quantifying that, I think, is still very, very difficult. What we do know is that all these backs and forths are generating a lot of uncertainty for those that need to make decisions in the real economy, decisions about investment, decisions about hiring, decisions about how much to produce. And we think that that uncertainty is probably going to lead to some cool down in growth. Whether we get to a recession or not, to be honest, at this stage, it's almost like a semantic discussion. The starting point is a good one, which is so far the data flow in the US is actually quite resilient, quite good. But, we could have a deceleration that stays just above zero or drops below zero, in which case it is a recession. But I think that you're going to start to see indicators of growth in the US weakening, indicators of inflation accelerating, and that's going to be a very complicated macro picture for the US, regardless at this stage of what happens at the end of the day with tariffs.
Okay, so uncertainty to kill growth. What about global slowdown? And which parts of the globe or the world will be more impacted than others?
Well, strictly speaking, to the extent that there's an element of self-inflicted wound, it is possible that the US falls into a sharp slowdown / recession, and maybe the rest of the world per se, on average, doesn't. That said, there's going to be a wide variation, dispersion of country experiences. Certainly those that are more integrated trade-wise with the US, starting with its neighbors, Mexico and Canada. Probably those two economies are already in recession or will fall into a recession in the coming months, in the coming quarters. Just because right now, everyone is holding their breath. We don't know the outcome of the renegotiation of USMCA that is going to happen potentially in the second half of this year. But then when we start to go around the world, you have countries like Vietnam, like Cambodia, quite integrated, sharing a lot of the exports going to the US, that even though the tariffs right now are 10%, we don't know, and these countries don't know, producers in these countries do not know what will happen at the end of this 90-day reprieve. So I think that is probably going to lead to lower growth, regardless, again, of what the outcome is. Other countries, obviously, may eventually benefit, but I think that right this minute, you're going to see a global growth slowdown pretty much happening everywhere, some places more accelerated than others, and it's only clarity that is going to lead eventually, hopefully soon, to some reprieve and some rebound. For the time being, we're all holding our breaths here.
Okay, yes, more integrated countries, more impact, and of course the neighbors already in recession. Now, what about inflation? Economists are telling us that there will be disinflation in Asia because, exports that don't go to the US will find a market here. Manufacturers are telling us that they're already seeing higher steel prices, for instance, because of anti-dumping duties and possible supply chain issues. What's your guess on whether here in Asia we are going to have more disinflation or inflation?
Well, I would say, again, different experiences. In the US, we think that inflation is going to be higher for the mere fact that imports are going to be more expensive. And they're not, the path to replace imports, particularly those coming from China, takes a while, right? To reorient your supply chains, to look for alternative sources of supply, of production, of imports of consumer goods. That will take quite a while. In the meantime, we're going to have inflation pressures. Again, the magnitude is very difficult to estimate. With the latest postponement until for 90 days of some of the harshest numbers of tariff increases, our economists are penciling in inflation, maybe staying inside 4%, maybe 3.8% by the end of the year in the US. In the rest of the world, we're going to see a mixed bag. Certainly, less growth in the US, less growth around the world means there's deflationary pressures coming just from weaker demand. But as you well say, there is a lot of fear that China, whatever they cannot sell to the US, they're going to turn around and try to sell it somewhere else, and they're going to flood the rest of the world with cheap exports, which is deflationary for many of these countries. That's one thing. The other one, and some countries may be forced just to protect the domestic industry to actually increase restrictions, tariffs themselves on Chinese imports from China. So again, very difficult, depends on the policy response to assess what the impact on inflation is. The one thing that is going to help at least the energy importing countries, oil importing countries, is the fact that oil prices have declined, right? India is certainly in that camp. And so long as authorities allow some of the pass-through from lower international oil prices to fall through domestic fuel prices, maybe that turns into a little bit of a offsetting factor for inflation when it comes to compare to whatever response there is on the tariff side.
Oh, yes. Crude will be a major offset for India. I'll come back to crude in detail, but first let me finish currencies. The dollar index has already fallen below 100, staying there. Do you expect dollar to weaken more? And what about Asian currencies?
So, in a way, for quite some time, we have had this narrative in markets and in the global economy of US exceptionalism, in which the US was the economy that was growing at the fastest pace within the developed world. It actually had interest rates, both in nominal and real terms, being among the highest across developed countries. Of course, the equity market was on a very strong upward trend. So there was nothing to dislike, right? And investors, I would say, globally were quote unquote overweight US assets, overweight dollar-denominated assets. Many of these pillars are changing, right? We're discussing now doubts whether the US economy could actually fall into a recession. We are talking about the equity market being a lot more volatile. Interest rates, the Fed at some point is going to start cutting rates. The acceleration of inflation is going to be eroding the so-called real interest rate. So the dollar, I think, probably has more to weaken here. We're not necessarily in the camp of those calling, this is a mega de-dollarization trend, and that it's the end of the story for the dollar, for the mere fact that there's actually no other currency ready to replace it. There's no other bond market like the US Treasury market that is as large and as liquid to take it over. So I think that this de-dollarization probably and this reduction in dollar exposure by the investors around the world will continue, but it's going to have a limit. But in that continuation that we're talking about here, in moving, let's say, from overweight to neutral, the dollar, probably the dollar has more weakness to experience. We have, for example, a forecast for euro dollar going to maybe 120, 122 by the end of the year. We had a forecast that was already out of consensus of 114, 116, and literally we saw that being hit last week already, right? And we're still in April. So I think that probably for the time being, we see weakness for the dollar.
Okay, so euro strength and more dollar weakness. Well, let me come back to the commodities. There are two key commodities that are important for India, also for the world. First, gold. Actually, today is a festival called Akshaya Tritiya when Indians buy gold. So what are your gold targets for the year? Also, what are your crude targets for 2025?
So for crude, we had a situation where oil markets were relatively, let's say, balanced, meaning supply and demand were at equilibrium up until last year. And this was because there was more production coming from the supply from non-OPEC producers, be it the U.S. shale oil production, reaching historical highs under the Biden administration. You had producers like Brazil, Suriname, Guyana, Senegal, that were increasing production, forcing OPEC plus countries to actually reduce production in order to preserve some kind of price floor and some stability, with mixed results. Now, and the demand side was okay. Now we're talking about all this trade war leading to potentially a U.S. slowdown, recession that could turn into a global slowdown / recession, in which case demand for energy, of course, will go down. And curiously enough, OPEC plus countries on the same day that the U.S. announced its tariffs, the so-called Liberation Day, April 2nd, they actually announced that they were going to be increasing production. Right, so it looks like they are now in the camp of looking to regain the market share that they lost. So we're looking at basically an oversupplied oil market where we're expecting oil prices to potentially continue to go down. So last year, Brent was in the mid-70s on average. This year, we're expecting it to be in the mid-60s. And by the end of the year, going into 2026, potentially fall into the high 50s. So the direction of travel is, we think, it's an oversupply market that is going to lead to lower prices. Obviously, that is bad news for exporters, but good news for importers, and India counts itself among them. In the case of gold, that is has become the ultimate safe haven amid all the uncertainty that we're discussing here, right? We had seen that it took around 12 years for gold prices to increase from $1,000 to $2,000 per ounce Troy. It took 4 years to go from 2,000 to 3,000, and it may well take less than 1 year to go from 3,000 to 4,000. We're halfway through it. Can we see 4,000 later this year? Absolutely, unless magically happens that reduces all these global geopolitical risks that we're discussing here.
Okay, $4,000 on gold. You're giving us a very big number on a day when people will be lining up to buy gold. Thank you very much, Luis Oganis, for giving us a 360-degree perspective on commodities, currencies, and growth. Thank you very much. We have to wrap up Bazaar on that note. Chartbusters coming up after the break.